crossing county lines just to make my name in the city. Took everything, put it on the line, cause I never break or back down. One shot is do or die, and the odds ain't looking too pretty. But I got the feeling it's my time. I know I'm taking it now.
Good morning and welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and today we're going to talk about that exact subject, retirement investing. How do you invest while you are in retirement, while you're preparing for retirement? The whole concept has to do with how much risk that you're feeling comfortable with making. And the very first step that you need to take toward that is building an income floor. But before I go into that, I just want to remind you, if you're listening today, thanks for joining in. If you have questions along today, and if you're listening to this on Tuesday morning around 11 o'clock, feel free to jump in and ask a question, join the conversation. If you're joining us on YouTube, make sure that you join and subscribe so that you're notified when our live stream comes up next. If you also are joining us on Facebook, any of the different platforms on Facebook, make sure that you like, and then you'll be notified also in the future when we have future live streams that are coming up, which at this point are every Tuesday at 11 a.m., unless something crazy happens. Also, welcome if you're joining us on Twitter or Periscope. And if you've got questions, type them in. If you've got comments, make sure that you leave them. If you just want to put a like down or a thumbs up, feel free to do that too. Any comments are welcome, and I'm glad to answer your questions as we go along too. Now let's get back into the topic that we're talking about today, and that is, how do you invest in retirement? The idea is that you want to be able to control your risk, because you really don't want to lose everything when you're in retirement or when you don't have enough time left in your life so that you're able to go back and build that base back up. A lot of people like the idea of building an income floor. This is the basis of where you are. This is going to be the safe money, the guaranteed money. This is such an important subject that 2 weeks ago, I did a live stream, and it was 100% dedicated toward building an income floor. So rather than go back through everything that we talked about 2 weeks ago, I'm going to suggest that you go on over to YouTube if you're more concerned about getting guaranteed rates of return, and watch that recording. I think you'll get an awful lot about it. Just to give you a little bit of a teaser of what it's about, take a look at this. You see, the idea of building an income floor it's really pretty simple to begin with. The idea is that we are matching liabilities with obligations. And you want to make sure in retirement income flooring that you're trying to keep the risk down as low as possible, so that if something happens, no matter what it is, whether it's going to be personal, whether it's going to be in the economy, whether it's going to be in the nation, whatever it's going to be, your basic needs are still going to be met. And when we do financial plans for people, we set that requirement and show people what it's going to take to build that income floor. A lot of times it is built with annuities or guaranteed accounts, or it's built with bond laddering. All that information is talked about in the video from 2 weeks ago. So if you're interested in that, go on over and listen to that after today, of course, because today what we're going to do is we're going to get more into the idea of how to invest money while you're in retirement. Now, when you're investing in retirement, you have to keep in mind the idea of the risk and the reward that you're going to be exposed to. Risk and reward, I call the yin and the yang of retirement. It's the good and the bad that's associated with it. It's I'm going to get a good rate of return, or I'm going to lose a lot of money from that standpoint. I explain to a lot of people that I work with in retirement or getting ready retirement that there is a retiree's motto, and you need to follow that to the letter. Take a look at this. The retiree's motto is really pretty simple, and I learned this a long time ago. I actually went to a retirement seminar that a lady did in Houston that was a preeminent financial planner, and she taught me about this a long time ago. And the idea is, don't put any more money into an investment than you can sleep with at night. Risk is an extremely important part of retirement planning. I want to bring this up because this is something that came up yesterday in an article that was in the Wall Street Journal. And you might not have seen this, but I want to show you this. If you can see this. See this? Bankrupt in just 2 weeks. Individual investors get burned by collapse of complex securities. This is about someone who invested in something that's called a leverage exchange traded note, an ENT. And the story centers around a gentleman that's 67 years old that invested $800,000 into exchange traded notes. And because of the chaos that's going on in the markets, it's basically worthless. So he went from $800,000 to zip in a matter of 2 weeks. How do you do that? Now, I understand the mechanics behind it, but part of it is too, if you're an investor, why are you putting yourself in that situation? I'm amazed. I see this way too many times where someone buys all of one particular asset. We're going to talk about how to reduce your risk in just a few moments, get into a little bit more detail, but it's not going to be real technical. It's going to be something that I think that just about anybody could get a hold of and be able to use. But don't put all your eggs in one basket. That's such an important concept. And if you're working or you're speaking to someone and they're saying you need to take all of your money and put it into this, you need to just say, thank you very much. I want to get another opinion from that. But the idea too is investment advisors, financial planners that you're working with should have a fiduciary responsibility. A fiduciary responsibility is going to be that that person, if it's me or anyone else that you're working with, has a responsibility to put your interest first. And that's the bottom line. I mean, it's kind of like, the best interest of someone is so important because it's what you would do with your own money. I wouldn't recommend something like taking $800,000 and putting it into one particular investment. You have to be to even qualify for an investment like that, you have to be what's called a qualified investor, and you have to have $100,000 in assets to be able to do so. But just because you've got $800,000 or $100,000 and you're a qualified investor doesn't mean that you should throw caution to the wind and put everything on one particular asset. That's so important. But the idea is when we're working with retirees and we're trying to help them find the right investments, the right mix of investments, there's a lot of information that's out there that's available. And I think that it's pretty confusing from the standpoint of what kind of information you should be using. Probably one of the most common things that you hear about is the average rate of return. And take a look at this just for a second. So the idea is, how do you match up which statistics to use when you're trying to find the investments that fit best in your retirement portfolio? See, when you work with an advisor, the idea is that what they're trying to do is they're trying to talk to you and ask you questions about what your preferences are, what you like, what you're anticipating, what your cash levels are. All that information is trying to be gathered so that they can match what your personal preferences are with what's available in the market and what might mix the two together. A good financial advisor works a lot like a sketch artist. And I kind of look at it like this. Take a look. So you as an investor, or if you're working with an investment advisor or financial planner, what they're trying to do is they're trying to ask you questions about what your preferences are, what you would like to utilize, as far as income goes, and how much risk that you're comfortable with. And they may be speaking with you about, well, look at this investment because, or else if you look at this mix of investments, it has a certain rate of return. But a rate of return, an average rate of return, is not as useful as you might think that it is. The idea is this, okay? If you look at, let me give you an analogy. Let's say, for example, that you're trying to change the body temperature of a person, and you take and you put ice on their head and you put their feet in the fire. Are you going to help them have a 98.6 degree temperature? I know that might sound crazy, but the idea is that if you have a high and a low and you're trying to get something that's livable rather than having, a frostbit scalp and burned toes, the idea is that you need to have something that's average all around. Now, let's draw this back to investments just for a second. Right now, we're going through a lot of economic chaos. And if you turn on the TV, if you're watching the news channels, you see a lot of commercials for gold. And I think that gold has a certain spot for some investors, but I think that if you're taking all your money and you're putting it into one asset like gold, I think you're maybe not as bad as the guy that took $800,000 and put it into the leverage exchange traded notes, but you're getting close to it from that standpoint. Here's the truth about gold. A lot of people don't buy just gold. They end up buying gold mutual funds, or they end up buying gold exchange traded funds. And when you do that, you're really not actually buying the asset. You're buying stock in companies that do mining or selling or something that's related to that particular precious metal. The idea too about actually holding the precious metal has its own problems too. Could you go to Walmart and give them a gold coin or a gold bar? How are you going to cash that in? How are you going to actually use it as a currency? That's an important concept to keep in mind too. But let's get back to the idea about the yin and the yang of investing, the risk and the reward that's associated with it. If you look at the exchange traded funds for gold, you're going to see that generally speaking, they're going to have a thing called standard deviation. Standard deviation is going to tell you about the risk that's associated with it. Now, there may be an average rate of return, but the idea is that standard deviation is going to tell you the highs and the lows that are possible that you're going to be having with investments. That's really, really, really important, because if you have a high of 10% and a low of 20%, how can you live with that as far as an income? It's like the analogy of putting ice on the head and the feet in the fire. How could you use that as something to build an income with? You really can't. The idea is that if you have a concept of where the risk lies, you're able to manage it a lot better. And I like to use the analogy of wading out to fish. If you're wading through water and you have an average, you see a sign and it says that the depth of the water is just 3 feet deep. Is it pretty safe then to go out and wade through the water and fish? Take a look. This is what I'm getting at. See, this is the idea of risk and reward. Okay, we looked at the idea of the average rate of return. And the average rate of return, if you've got a 10% average rate of return, you need to understand what the standard deviation of that investment is. If it tells you that you have a standard deviation of 15, then that means that 2/3 of the time that particular investment could be up as much as 15%, or it could be down as much as 15%. Standard deviation is an important tool too, because it defines the downside as well. Not only is it going to look at just the 15% up or the 15% down, it's going to look at the possibility that about a quarter of the time, really it's more like 26% of the time, that particular investment could be 2 standard deviations off. In other words, it could be as much as 30% up, which is great, but also it could be as much as 30% down. Now, here is the dark side of standard deviation. There is a 5% chance with any standard deviation number that you're looking at that it could be higher or lower than the number I just gave you. In other words, it could be higher than 30%, or it could be anywhere lower than 30%. So it could be 50%, 70%. There's an outlier in there in standard deviation. Now, we try to live in a world of averages, but gosh, right now with what's going on from the pandemic to the riots, living in an average world is not, it's something that we hope that we get back to, and I'm confident that we will. But if you're looking at investments and you're trying to invest toward retirement, you should be looking at lower standard deviations so that your concept of how much downside risk that you have is lower. And that'll be so important as you look towards the future in investing. Now, so far, the idea is I've been talking to you about using one particular asset. Now, I haven't said it's a stock or a bond or gold or whatever the case is. Well, I did talk about gold just a little bit. But the idea is that if you have too high of a rate of return, what you want to be able to try to do is to mellow that just a little bit. You can use a couple of different techniques in standard deviation and blending the standard deviation so that you can reduce your risk. And I kind of equate it back to food because I think that food analogies are great. And I want to bring this one up. Watch this just for a second.
Gimme, 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 gimme love. Gimme, 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 gimme love. Gimme, 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 gimme love.
Okay. I love chili. I love Texas chili. I love food in general. But the idea with the 2-alarm chili is that you can use the concept of standard deviation and diversification to make your chili spicier or less spicy. Now, in the 2-alarm chili, actually, I've got this. This is one of my favorites. You ever seen this? This is awesome stuff. Okay, 2-alarm chili. But if you're going to make 2-alarm chili, let's take a look and see what's in here. Kind of open it up and see what's in there. All right. The first thing that we have is we have the red chili pepper. Okay. What else is in here? We have onions, masa flour, paprika, and this looks like onions and oregano. Now, here's the part that makes this very spicy, the red pepper, okay? This is the idea of how that you can use diversification to make your investments safer. Now, if you have the 2-alarm chili and you want to be able to make it 1-alarm chili, what you're going to do is you're going to take half of this and you're going to put it into your meat. And yes, I did say meat because in Texas, we don't put beans in our chili. There's a short little story that goes along with that you might have heard that in Texas, the beginnings of chili go back to San Antonio around the 1860s. There was 2 ladies in San Antonio that were selling chili in the military square, and they sold chili without meat. Of course, they sold beans on the side and tamales or just as an accompaniment, but there was no meat in there. Okay, back to what we're talking about, diversification. Here's the chili powder. If you want to have a really spicy chili, you're going to take and you're going to dump the whole thing in there. If you want to have a moderately spicy chili, you're going to take and you're going to put half of that in there. That's the idea with diversification too. If you have a very risky investment, you want to put half of it maybe into your mix of investments, your portfolio is what you would call it, and you're going to have less risk associated with it. If you want to have what's called false alarm chili, then you just basically leave that out and you don't have any risk that's associated with it. The idea in investing is that the only way that you can avoid risk is not to take it. Investments like stock investments, bond investments have something, it's a technical term that we call systematic risk. And the only way to do away with systematic risk is absolutely avoid it. So you might look more at guaranteed accounts, and that might be something that you look for. It's a little bit more complicated than that when we start trying to blend investments together. It's more than just taking, one particular asset and trying to split it from that. The whole concept of blending investments to control risk was first looked into and written about a lot by a gentleman by the name of Dr. Harry Markowitz. And it was quite a long time ago. Actually, Dr. Markowitz is still alive today, and I believe he's in his 90s. And he came up with the idea of the modern portfolio theory. The modern portfolio theory actually does this, and this is the way that I explain it. You're buying some investments that will move in a different direction than other investments. When one zigs, the other will zag. Now, it's a lot more complicated than that, but I think that that's the basic idea that you need to look at when you're thinking about using the idea of reducing your risk. Now, I want to share with you what I call my secret sauce of investing. And this is actually how I use the concept of the modern portfolio theory. Take a look at this, and I think you'll get the idea. The way that I use the modern portfolio theory is what I'm doing is I'm categorizing investments into 12 different categories. And this is not something that I thought up myself. This is something that's a standard practice with using the modern portfolio theory and managing people's monies. I divide it up into 12 different categories, and it could be something that's as conservative as a cash investment or as complex as commodities. Now, not every portfolio that we recommend at our firm has every single asset in it. What we do is we take those 12 different asset categories and we have 9 different models that we split it up within, and it'll go from very conservative to more aggressive. And when we are using the idea of modern portfolio theory, we are giving up some investment possibilities. In other words, if you went back and you looked at that investment I talked about that the guy lost all of his money in, that's something that we would really never put into an investment portfolio because it's an outlier. It's too risky. It's just out there on the edge. Now, when we get into economic times that we have right now, sometimes people's preference for risk changes. The 9 different portfolios that I utilize, when we're putting those together, that's called the statistical asset allocation. And actually, when we're looking at the strategic asset allocation, geez, I'm getting my words ahead of myself. The strategic asset allocation is the 9 portfolios that I was talking about. So if we're trying to reduce the risk, we have a very conservative investment mix on one side, and we have a more aggressive investment mix on the other side. But a lot of times when we have economic events like what we have right now, where people are seeing their investments wildly gyrate in value, go up and down quite a bit, they might change what their preferences are. In other words, their strategic asset allocation may change. They may have thought, okay, I'm on the number 9 portfolio, which is really risky. I don't like that. So I think that I would rather get into something, I would rather live with less possibilities for return, but I want to have more safety associated with my values. And at that point, we would change from one model to another model. Now, economic events change people's preferences for their strategic asset allocation, and also life events. Maybe you're going to retire, or you have a family event like a spouse passes away, or you have another family event like a child is born, or you're trying to will money or assets from one generation to the next. So you may want to change your strategic asset allocation. When you get to that idea, I think back to the concept of food. And the idea is that, have you ever tried a spicy dish and you just thought, I like spicy, but this is just way too much out there? And that's the same idea with investments. If you're going through life and you think, okay, I have this mix of investments and it's just a little bit too aggressive, I'm not comfortable with that. Take a look at the idea that I'm trying to relate this to as far as food goes. Okay, when we're talking about asset allocation, the strategic asset allocation, think of it like this. If you're in an investment mix and it's just too much volatility for you, then maybe go to something that you're more comfortable with. If you don't like the idea of Thai chilies, then don't eat them. And if you're not brave enough to try the fall curry, which I'm not, I've tried the Thai chilies, the fall curry I'm not quite into yet. The ghost peppers is just a little bit further out there. I'm not comfortable with that. So I might not be a number 9 portfolio. I might be more of a number 6 or maybe a number 5 portfolio, where I like a little bit of spice in my investments, but I don't want to go crazy with it. Now, so far we've been talking about the strategic asset allocation and how that is related back to the risk that you're comfortable with. But what do you do about the small changes or the changes that happen in real time? How do you handle economic events like the coronavirus? How do you handle other economic events that may be affecting investment values? That's where we get into something that's called tactical asset allocation, where we're looking at the individual investments and how they're being affected by the events of the day, and we're trying to react to that and not have knee-jerk reactions. But what we're doing in tactical asset allocation is we're trying to take advantage of opportunities, and we're trying to avoid danger when it comes to investments. And I've made a video that's completely about this. And if you go actually over to my other Facebook channel, and some of you may be watching this on that particular channel, it's the Retirement Learning Lab, which is the name of our show. You can see the video I'm talking about where I go into more detail about how actually the coronavirus and the what I call the COVID-19 recession recovery is progressing and what's going to affect that. This is really what I'm trying to get at. Take a look at this. What has happened with the coronavirus is that the coronavirus has made a lot of people make small changes in their investment strategies. They're making changes in their tactical asset allocation. The coronavirus has been what I call a notorious revealer of trends and weaknesses. And in the video, all you have to do to see it, that I'm going to talk more about this, if you go over to the Retirement Learning Lab Facebook group and you subscribe to the Facebook group, just ask to join and I'll make sure that I enter you into it. And then you can watch the video. And the video will go through a couple of different things. One is the video is going to go through 3 different things that are happening in the economy that's going to boost it, move it forward. Then I'll discuss 4 different concepts that are possible reasons why the market could go backwards some. And then the really piece de resistance is going to be the 5 different trends that are happening right now in investments that are actionable. These are things where we look at the trends that are happening currently that are opportunities and how to take advantage of those, or we're looking at the warning signs on particular assets and how to avoid some of those. So the concept of using tactical asset allocation can really help you to control your risk, not only in the immediate future, but in the long run too, so that you're able to get a better return on your investments, and you're able to do something that we've talked about through this whole broadcast, and that is to control the risk that's associated with your investments. So we've talked about a lot today. And gosh, if you've missed something, go back and listen to the replay. I'm going to take just a quick second and see if there were any comments. And if we've got any comments, I want to take a few moments and talk about those. Okay, looks like we're blank for right now, which is quite all right. Okay, where do we go from here? We've talked about the idea of building an income floor. Then we've talked about the idea of which investment statistics do we utilize. And then we've talked about the idea of using standard deviation and how that you need to be cautious in looking at diversifying with only a few investments. And then we've talked about the idea of how the modern portfolio theory is used. And then I gave you my secret sauce. You can go back and see that, where we talk about 12 different categories of investments and 9 different models. That's where the management goes into the strategic asset allocation. And then we've progressed to where we just were and talked about the idea of tactical asset allocation. So where do we go from here? How do you actually take an income from the investments that you have? And really, that's where we're going to pick it up next week. This is about all we're going to talk about for this week. If you're listening to this on a replay, I really invite you to, if you're on YouTube, go over and subscribe so that you can find out when this is going to come up next. If you're on Twitter, you can also do the same thing through Periscope. You can be notified when the next broadcast is coming up. And subscribe to my Facebook page. Join the Retirement Learning Lab Facebook group. Join in the conversation. We ask questions. You can learn from other people's experiences too on the Retirement Learning Lab. Follow me on my Facebook page on Richard's Financial Planning. And if you'd like to talk to me about your particular situation, come on over to richardsfinancialplanning.com, and you can arrange to find a time where I can talk to you just a little bit about your situation. So what are we going to talk about next week? This is it.
The beauty of your side.
How do you take all that information that I just talked about, and how do you use that to create an income? That's going to be next week. Till then, I hope that you stay safe. I hope that you stay well and have a great week.